Today we are joined by Richard Brown, CEO of R3. This is a bucket list one for me. For more than a decade, R3 has built distributed ledger infrastructure for major financial institutions worldwide. Through Corda, R3 supported tens of billions of dollars in assets across production networks serving banks, exchanges, and core market infrastructure providers. But as public blockchain infrastructure has matured, R3 is now exploring how institutional market infrastructure can connect directly into open networks. I'm super excited to have you here today, Richard. I want to kind of kick us off here. If you could describe R3 and the idea of bringing kind of this being this institutional gateway to DeFi, that would be fantastic. And thank you so much.
Well, first of all, thanks for having me. It's great to be on. So R3 has gone through quite a big change in the last year or so. But maybe I should start at the beginning. So if you like, we're kind of the firm that invented the idea of the private permissioned blockchain. So back in the day when everyone was poking fun at that meme, sort of like it's blockchain, not Bitcoin. I have to apologize that was us. So we were the guys behind that. But there was a good reason for it, because we were founded back in 2014-15 with a really, I think it was quite an interesting idea, which was as a bunch of sort of traditional finance technologists, sort of like I was at IBM, bunch of like senior people across the financial industry. Can we help the banking industry as it was back then? Could we help the banking industry figure out what this blockchain thing, this is 10 years ago, what this blockchain thing might mean for them? So we got started trying to help like this sort of like bridge the traditional financial system with this emerging blockchain phenomenon. But of course, there was a big problem back then, which was like there was no way those banks could directly connect to permissionless blockchains. I mean, I say permissionless blockchains, I mean Bitcoin. That's kind of all there was back then. There was the Ethereum yellow paper, the white paper, but that was about it. It was just terrifying. I used to joke that if we would go to these meetings with banks, and we'd sit in a meeting room, and if you said the word Bitcoin, the people's faces just would go white. They were kind of terrified that someone from compliance was going to jump out and arrest them. So the question we asked ourselves was, well, how can we make progress? How can we actually bring some of this technology, some of these advantages to banking without actually being able to interact with it directly? So that led to the private permissioned blockchain concept, and we had a lot of success. So I led the team back when I was CTO that built Corda, which is the Corda blockchain now in version 4. Like is if you like, it's the dominant private permissioned blockchain. There are tens of billions of dollars of assets issued across these networks, these private networks. Millions of transactions a month being processed, and it's been a modest success. But these are separate, private, isolated networks. And so if I fast forward now to what's changed. We kind of did quite a big strategy review, I guess a year or two ago now, which was to say, well, those assumptions that led us down that path of separate private networks because we couldn't interact with permissionless networks, do those assumptions still hold? And of course, the answer was no, obviously not. Regulation has changed. The headwinds have become tailwinds. It's a cliche to say that, but that was obvious a year or two ago. The technology has matured. You look at things like, a lot of the early mistakes on some of, remember the DAO hack back in the day with Ethereum, all that's matured. There's audits, and there's now mainstream institutions, primarily on the buy side, the fund managers and so forth, issuing. And so the conclusion was, and maybe I'll pause here. It was, we've achieved a huge amount, but there's no longer any reason to have this separation between private and public. And so the question was, do we allow this convergence to happen to us, or do we lead it? Do we lead this convergence of TradFi to DeFi? And that brings us up to, I guess, a year or so ago, when the question then was, okay, well, if we're going to do that, what will we do? How do we do it? Who do we partner with, and where do we go from there? But that was the journey.
No, it's super interesting, and I think my next question is, when did connecting to a public blockchain or infrastructure kind of become the next logical step? And I think you kind of lead us into that, about a year ago. So those discussions happening, I guess, as a broader question here, because you kind of tackled the why a little bit. We have seen just so much real world adoption in the past 12 to 18 months. That's, you're certainly an OG. You've been here way longer than I have, but I remember back in 2016 and 17, if any one of the announcements that we see maybe 5 or 6 times a day now would have been the entire news cycle for 6 months. What has that, I guess, as a more of a curiosity stance for me, what has that experience been like for you? Is it like vindicating to be like, wow, this technology is really, coming to fruition?
Yeah, I mean, it was super exciting. Probably about, I guess, about 15 months ago, when I was, I was leading a lot of or helping with a lot of the strategy work, and doing some of the technical analysis. And I actually went back to some of my blog posts from 2013, 2014, even before R3. Where I was like, I was like, I guess I was like speculating, I was fantasizing about, what might happen. And this idea of like, so we used different terminology, but this idea of having tokens like, on a public blockchain that represented an ownership interest in something in the real world. We call that tokenization or real world assets now. We didn't use those terms, but those ideas were kicking around, 12, 13 years ago. There was the Colored Coins project. There was an attempt at that going back, I think, to all that stuff. But it kind of feels like our worlds, the private and public worlds, kind of split. There was this schism in 2015 where the worlds went separate ways, and what happened was, we each developed in our own way. So on the private space, we learned a lot about how do you actually get things on chain, how do you actually get integrated into existing banks, how do you actually get the lawyers comfortable, all that work that had to be done. And then on the public side, there was this massive accelerated maturation of the technology. We saw Ethereum, then we saw the Ethereum forks. Now we see things like Solana and other architectures. And then to answer your question, it's probably only in the last year or so we've begun to see that those predictions from 10, 15, 10, 11 years come true, because it's no longer just self-referential yield on chain with a bunch of sort of like of tokens that are being traded. As useful as that is, we're now seeing obviously with stable coins and yielding stable coins, and then we're focused now real world assets, a token on a permissionless chain that confers a legal right to something that exists off chain. And this isn't just sort of like isn't just sort of like fake. There's real legal backing, and there are firms, I'm take Biddle with BlackRock, but other firms, but there's a convergence of the legal structuring and the technology, so that ownership of that thing on chain really does give you economic rights. And so we look at it and thought, aha, this world that we predicted is now coming true. So now we need to drive these things together, because I guess front running where this conversation might go. Just because you can bring some real world assets on chain doesn't mean anybody's going to buy them. You have to actually meet the needs of the on chain allocators. You have to meet the market where it is. So there's a lot of work to be done. But that idea of using this open, permissionless, neutral substrate where everything happens without the siloing of one asset here, one asset there, but everything in one place is like it's the dream we've all had, and now it's actually possible.
I have to say, I've probably done 1,000 of these interviews, and I can probably count on one hand how many people have brought up colored coins with Bitcoin. So unique items on chain. So that is an old school, and certainly a lot of knowledge there. And yeah, it's interesting. It seems like we do have these kind of back to the future moments occasionally in blockchain and distributed ledger. I remember in 2018, 2017, micropayments, seeing a lot of micropayment aspects out there. And then it kind of went away and disappeared for 3 or 4 years. And we're talking about micropayments again. But I kind of want to ask, so obviously you guys do a ton of due diligence out of R3. So when evaluating public blockchains for what you envision as kind of on-chain capital markets, what characteristics mattered most? And how did you guys end up choosing Solana to kind of be that cornerstone partner?
Yeah, and I should say up front, I went into this not expecting that the answer would be Solana, so I was kind of surprised by the answer we got to, and it was like subsequent to the announcement, and we were at the Accelerate conference in New York in May, and I still had some trepidation, have we made the right bet? And then when I actually experienced that community for real, I kind of realized it was such the right answer. But stepping back, how did we get there? So I guess there's two sides to this, which is what are the requirements that we needed the network to meet, and then why did we select the one we did? So requirements. Okay, so what is it we're trying to do? Two main things. Part one of our vision is over time, and the market needs to be ready for this, but over time, helping our existing private networks connect directly to a permissionless L1. So the networks remain private, but they get their consensus and hence their security from the L1. So they need to be able to they need to be able to connect and have the transactions confirmed on the L1. Why? So that they can then bridge the assets. So all these assets that are being collected on our private networks, as and when there's demand for them on chain, you latch the network on, and then you can almost like hit the pinata and the asset flies out, and you can now bridge it on the other side. So we needed something secure and high performance that would allow that to work. So that was requirement number one. And then requirement number two was so that's how we got here. But where are we going? Our singular focus for our new development is building high quality RWA yield vaults on chain. You almost think of them as like on chain mutual funds, something you put your money into. It owns the underlying asset, and it then provides it with the right wrapping, whether it's a liquidity layer or the right permissioning. So you net all that down. We needed something that was an L1, because if we've got Corda networks connecting to an L2 that then sits on an L1, that's getting pretty rickety. That's not a good architecture. So it had to be L1, which meant it had to be high performance, it had to be reliable, and it had to be one where we believed in the future. We thought this was going to be something that we could sell to our customers and we could trust for the long term. I assumed it would have to be EVM. Back in the old day, no one got fired for buying IBM. Today, no one gets fired for building on the Solidity EVM stack. So my assumption was that's what we begin with. Now, of course, Ethereum is an L1, amazing, but it doesn't have the performance. There's not that many high performance EVM L1s. So there's one or two, and we did look at them. But you still got the issue with EVM, which is it's inherently single threaded. It is hard to get it to go fast. So we broadened our analysis, and I started looking at Solana. And then as I went down the rabbit hole, I thought, these guys, I don't think they sell it well enough from a technical perspective. They did some really interesting engineering. The way that, so I'll just give one example, because I could go too deep on this, but if I take a step back, why do people say Ethereum is single threaded? And it's not a criticism; it's just how it works in general. It's because when you send a transaction to that network, you don't know what it does until you run it. So you don't know which part of the ledger it's going to read or write from. So if you're going to process two at the same time, well, what if they try and write to the same place or they read from the same place? It's hard to deal with the fact that they might conflict. So in general, you just run one, then you run the next one, you run the next one, and that puts a limit on your speed. Solana does something differently. It makes it slightly harder for the developer. But what you do when you send your transaction is you say, here's my transaction. And by the way, this is the part of the ledger it reads or writes from. So the sequencers, the validators, they've got a happy life now because they can see all these transactions coming in and they say, well, that one, these 1,000, they don't conflict. I can process them at once. So you now get this massive throughput. Second thing was we were terrified about security. Like, how do we get our customers and our ecosystem comfortable with this? So the idea that every time we issued a token or we bridged an asset, we'd have to get the underlying token contract audited, the ERC20 implementation or whatever it was. It's just hard and painful. You look at Solana. There's only two tokens. There's a standard one and the extended one that is built into the platform, extensively audited, and everyone just uses the same thing. So there's a whole bunch of reasons, and different choices for different folks. Different people will make different choices, but it was just so obviously for us the right architecture. And then the final point, in terms of just the leadership of that community, the foundation and the and labs and so forth, there was just a real meeting of minds. We see the world the same way. You're just very, very commercially focused. We just want there to be a single shared, massively scalable L1 that everybody uses. So yeah, a bunch of reasons, but I've never regretted that choice.
So I think really interested to hear your insight because obviously you are very familiar with all of the traditional markets that exist out there. So mutual funds, obviously there's repo markets, securities lending, collateral management, all of this stuff that is going to, I guess in the short term, the way I kind of look at it is it's going to exist where it traditionally does, but it's also going to exist on chain. And from your stance, why would these markets exist on chain rather than just stay in the traditional closed loop systems? I would assume that they maintain the value proposition that they already do. So I guess then the question becomes, what value is added to make it make sense?
Yeah, so there was a lesson we learned perhaps too slowly in the in our historic business, which was you've got to look at where the new money is. So we had we've got lots of successful networks, but also some unsuccessful ones over the years. And one of the issues was in the old private permissioned world was you go to a lot of trouble, you build a new network, maybe you're issuing tokens or whatever it was. But then what you'd find was it was the same investors, so the same pool of capital, the same pool of demand. It was you hadn't actually expanded the demand for the asset, and so you just added cost, but you hadn't grown the market. So the lesson I took from that was that follow the money. So if I now look at the permissionless side, just take Solana for example, we're very very focused on, we just call them allocators because anyone who can allocate capital. So whether it's it's just like individuals, whales, institutions, stablecoin treasuries, whatever it is, increasingly there is a large and growing pool of capital on chain that wants to stay on chain. They've made their money, they're professional or they're individuals or whatever it is, but they no longer want to play the old game of, if they want to get access to something that isn't just crypto yield, they want to get access to private credit or whatever it is. Why should they have to go to the trouble of getting selling their tokens, moving it into the traditional system to play the game of the existing world? It's their money. The supply should come to them. And so the key thing for me was, okay, so there's a new source of demand that is on chain. Our opportunity, our obligation is now to bring the supply. So that's helping tokenize assets on chain, but then package it in a form they want. So what does that mean? Make sure it's got the right liquidity, the right yield, the right accessibility, all that stuff. But then you think, okay, so then your point about markets. Okay, well if that's the case, well, it's all very well owning an asset, but if you're sophisticated and you own an asset, well, you might be long-term bullish on it, so you don't want to sell it, but you might need cash in the short term. Okay, so there needs to be funding markets. I need to be able to borrow against it, so collateralized borrowing. In traditional finance we call that repo. In decentralized finance we call it a lending protocol. So it's almost like is the tail wagging the dog or the other way around? But if there's owners of assets on chain, the assets live on chain, then okay, I want repo. Okay, well I need to be able to lend against it. I want to be able to loop it. Maybe I want to be able to act as a lender myself. So all the downstream sort of like the financial market structure, it emerges over time to satisfy the needs of what's at the top, which is where the buyers and sellers meet. And of course, I guess my final observation is, as you look at the structure of DeFi markets, that's what we see, because it didn't require real world assets to build that. Things like like on Ethereum, Ove existed. It exists to solve a real problem. So that market structure is developing. But net, we will see more and more activity move from TradFi to DeFi to the extent that the value and volume of on-chain allocators increases, because that's what's driving it.
Yeah, I think I bring this up occasionally, and this is just mainly a sidebar. If you look at kind of the ultra wealthy out there in traditional finance right now, they leverage their assets in a lot of different ways, and I think that the other 99% just don't necessarily do that. I kind of look at blockchain and distributed ledger, the end game, as these markets are democratized and as access is democratized, you'll essentially be able to have the every man and every woman participate and leverage their assets in a very similar way, where it won't matter if they have $100 in their bank account or $10 million in their bank account. Hopefully that's the future that we're getting towards. But you alluded to this earlier, Richard, and at Solana's Breakpoint conference last year, you talked about the disconnect between what traditional finance issues and what on-chain investors actually want. And I think you put it perfectly, which is just because you can tokenize something doesn't mean that anybody wants it. So what does that mismatch look like in practice? Why hasn't tokenization alone solved for that disconnect yet?
Yeah, so I guess there's two sides to it, because I'll just build on your point about democratization, because I struggle with that term sometimes, because I think that's what we're doing, but if one doesn't say it the right way, it sounds self-serving, because it was always like, back in the day, I always cringed when I heard people talk about things like, oh yeah, Bitcoin is going to sort of like it's going to provide banking for the masses, or it's going to help with remittances or something, and it always felt a bit, it never quite resonated. But on this democratization point, I think there's really something to this. So just take, for example, private credit. Now, who knows whether that, how that market will develop over time, but there is this, there is this alternative asset class that right now is predominantly only accessible to let's say well-connected or rich, eligible investors in certain countries. And some of that is for investor protection, because it's quite risky. But some of it also is because of the way it's structured. Unless you're going to write a check for $100,000, you can't access it. Whereas there is a way to solve that, and it's not just us, others are doing it. You can today go on Solana, go on Ethereum, and you can spend $10 and get exposure to one or other private credit fund. And the economics of the blockchain makes that work, but also some clever structuring that is compliant, but is something that hadn't been tried in the TradFi space. So there is making it possible. There is this thing about making it possible for someone in a single place, so without having to have 20 different brokerage accounts, single place, you can get access to any type of asset in any ticket size. Importantly, with liquidity, you can enter and exit the position as quickly as you like, and in a way that is then fully compatible with DeFi, i.e., you've got access to the professional trading tools and so forth. That is possible. But if you look at what's actually happening, so you just go to the Blockchain Explorer, go to SolScan, go to EtherScan, you look at some of these funds that have been tokenized. To a large extent, you see something quite strange, which is there's often you click on the holders tab on SolScan or EtherScan, and there might be 3, 5, 7, not many holders, and there'll be 2 or 3 whales. So there's clearly been some allocation, but there's not a huge amount of the long tail just isn't that long. I think it's for the following reason. It's like the expert, and of course I can't speak for everybody, but I will just generalize. If I've got like stable coins on chain, I've got a lot of choices. I can buy Sol and stake it, and I haven't looked recently, but I could probably get 5-6%. So like the risk-free rate, if you like, is higher than off-chain. So, and typically right now, people on chain have probably got a higher risk appetite. So the bar for yield is higher. There is an expectation of liquidity. If I can enter or exit all my token positions rapidly, then having to wait 3 months for a redemption window on a fund, that is not acceptable. I need to be able to buy in small sizes as well as large sizes, because that also helps people build confidence. I'll try it, understand how it works, and then when I really understand it, increase it. So there's all these things. There's being able to enter and exit the position rapidly. There's being able to do it in small size. There's making sure we get the permissioning right, so it's compliant, but doesn't go over the top. And then the final thing is it's got to be compatible with the broader DeFi ecosystem. And just to give one example of that, let's imagine I owned a token that is a direct claim on a fund. Often that has to be locked down because only certain people are allowed to have that. Only certain people can redeem. So I can't borrow against that, because if I default, who's to say the lender who would then own that collateral, who's to say they're able to redeem it? So why would I lend against an asset that I don't know I can redeem? So you actually need to go to, so you then have to help upgrade the structure of the lending market, the RWA Horizon, that kind of thing, so that the collateral can be liquidated. So there's extra work to be done. But yeah, just because there's something that's attractive in the TradFi world, it doesn't follow the DeFi world will want it. You do have to package it and structure it for the needs of those customers.
I think it's super interesting. And again, just a tiny sidebar, I found it so fascinating to watch the past year to 2 years, and how there's almost this flywheel straight from Web3, from the innovation side, that goes, that almost seems to have inspired or set off a light bulb for the institutional side, that is now actually coming back into Web3 to cause probably what's going to be a lot of the mass adoption, and driving forward the compliance and some of the other stuff too. And I think you put something so smartly, which was it gets people comfortable. And I think that is so massively important. As you mentioned, we saw a lot of the same things from the public network side with recycled liquidity and stuff between different networks. I think sometimes we have to step back and realize, look, 99% of people aren't using this technology every day yet, but they will be in the future. And they have to be comfortable whenever they come in to use it, and they have to feel safe. So I guess from your stance, you talked about the yield vaults on chain. And I think that's really fascinating because, I kind of allude to, a century ago, mutual funds packaged assets in a way that made them accessible to investors. How do yield vaults there's going to be lots of products that come out, improve that model on chain, and why does that unlock, in your opinion, growth for real world assets or RWAs?
So I think Sometimes I like to do a thought experiment, which is like imagine there were no costs, and so imagine imagine if activities were free, then you could argue that the mutual fund already solves the problem. So it's what is it? It's a legal entity that owns some stuff and sells shares against it. So you buy the shares, and then and then you buy shares in a box, and inside that box, there are various assets, and then maybe there's a mutual fund manager whose job it is to manage those assets. Okay, that's a really good innovation, because it means you don't have to make the individual investment choices, that somebody else is looking after the box, making sure the securities don't get stolen, and then it enables the creation of a market, because you think, okay, so we've now got a distinction between the underlying assets, whether it's your equities or gold or whatever it is. You've got a distinction between them, and then people who can sort of specialize and professionalize as people who are good at picking portfolios. So you might call them a portfolio manager or an asset manager in TradFi. You might call them a curator in DeFi. So, but of course, they're expensive. There's a lot of regulation, a lot of it well-meaning, but there is regulation around it. You've got to set up a legal entity for each one. You've got to market it. The more expense there is, then you've got there's a cost of dealing with customers, and therefore you have the large ticket sizes for some of them. These things are sort of almost like there's a vicious circle. So you then look on chain and say, well, can I create the same structure but do it with radically different economics? You think, okay, well, I can create a box, just a smart contract. So something on chain that owns assets. We can see these. You go into a blockchain explorer, you look at a contract, you click on assets, you can see what it owns. So that feature that already exists. So what is a yield vault? A contract that lives on chain. It can own some assets. In our world, these assets would be tokens representing real world asset tokens. So we're focused on the real world, and then issues a token against it. Let's call it your vault token. So you own that, and you own a proportional claim on the assets in that box. And then on the side, a curator can come in and manage it for you. So to a first approximation, I think of what we're doing is building a marketplace, i.e., somewhere you can go to choose which ones you want to invest in. So a marketplace think of it as on-chain, highly optimized, low-cost mutual funds, but it's just different terminology. So I think is the key thing. But I think you said something else really interesting about trying to about making it sort of like make it less scary for people. And something we're debating right now is, okay, well, you have a marketplace. How many products do you have in it? How curated should the marketplace be? So an example I give is, you're in the market for a new USB-C cable. You go to Amazon, you just do it. Go to Amazon, search USB-C cable. You get like a million choices. It's absolutely overwhelming. How are you supposed to know which one to buy? And it's the same here. If we've got 20 different, let's say private credit, we've got 20 separate private credit funds curated by, say, 15 different curators. How do you know which one? And that problem of there's too much choice. What happens? The answer is you don't make a choice. You just don't do anything. And I see that in my traditional brokerage account. I go in and it becomes stressful thinking, where am I actually going to invest? But you look at how's this been solved in the real world? Well, it's been solved. Maybe not well, maybe well. If you're going to buy a USB-C cable, unless you know what you're doing, you click on the one that says Amazon Basics. There's a curator. In this case, they call Amazon. It's not going to be the best, but it's probably going to minimize regret. It will be good enough for what you need. And so I think there is this need as well, not just on the technical side. We've got an obligation as the project bringing this to market. We have to help give people. We can't advise or guide because there's a whole bunch of regulation there. But say, in the absence of any additional knowledge, this is one that you probably won't regret. It will be good enough. I think we do have to offer that, because otherwise people, they just get overwhelmed by the choice. It's like going to the supermarket and there's 20 types of mustard. Which one do you buy? It's too hard.
I think it's super interesting because you can look at I remember our 401k when I was still doing project management, and there was zero choice. I mean, there was the choice was basically I want to invest in the high tech. There was a couple of different options. It's you can be safe, or you can go high tech route for your 401k. And it's there was no way of me even knowing what was in the high tech portfolio from through the traditional.
Yeah.
So one thing that I think, as you mentioned, that will kind of naturally happen is blockchains, especially public ones, are very great at transparency. So people should be able to kind of know exactly what's going into their portfolio. Now, then, as you mentioned, though, it all becomes about how do we make that as simple as possible. I think you guys have some huge milestones coming up this year. The real world asset marketplace on Solana between you guys is supposed to launch in early 2026. And please correct me if I'm wrong. I would love to know how that marketplace works on Solana, what role curators and stablecoins will play in connecting institutional issuers with on-chain investors.
Yep. So we're targeting first half for the launch, and like all launches, the V1 is always, it's almost like, it's get it to the point where it's viable, and then you iterate. So we'll probably launch with only one or two vaults in the marketplace, and they'll probably both be brought there by, we'll have helped sort of make that happen. But of course, it will then grow hopefully rapidly from there. So what should users expect on day one? Well, the first thing they'll see is, if you like, is day zero. Once we know that we're on track to having it ready to launch, then we'll, let's say 45 days before that, the timing's not quite set. Shortly before that, we'll launch the pre-deposit vault, so we can start saying to people that here's your chance to sort of pre-commit your funds, so that when it launches, you're at the front of the queue to get into the vault. So there'll be there's almost like, in terms of, you mentioned project management. From a project management perspective, there's when will the first vault be ready? The back end of first half, T minus 45 days, the pre-deposit vault. Everything is sequenced like that. So what would be there? So it would be in some ways it's not going to be particularly revolutionary on day one. So it would be like typical, go to the website corda.xyz, you click on the app at the top right, you go to app.corda.xyz, and you'll see a selection, maybe a small number to start with, of vaults into which you can deploy stablecoins, for which in return you get a vault token whose value will track the performance of the underlying portfolio. So that's it's like the highest level picture. Now, of course, because these are real world assets, and this is like the super interesting thing, and maybe this is where people will hopefully get comfortable, but may not be yet, is in order to be able to invest directly, so primary issuance, there does need to be some level of KYC. The underlying investment funds need to know who that customer is. So there'll be some degree of KYC to be able to subscribe or redeem. But what we're working very hard on, we may not be there on day one, but we're working very hard on, is to make sure that the secondary trading, so that once you own the token, it's permissionless to exchange that with other people. Now, of course, somebody ultimately wants to redeem it, they'd either have to sell it to someone who's KYC'd or get KYC'd themselves, but there'll be permissionless movement of the assets. So I think that's probably the right spot. So when you're interacting with the real world, there's permissioning, but once you're on the DeFi side, there isn't. But that's sort of like the picture. And then the question is, well, the vault, let's call it it's the Corda protocol. We're calling this the Corda protocol flagship vault. It's maybe a private credit backed fund, let's say, curated by. So you say, well, who's curating it? Who's taking responsibility for making sure this is the right thing? So that's where the curator fits in. And then over time, we'll invite other curators to come in and offer their own ones. And the challenge we've got to get is, how do we have a wide range of offerings whilst also not making it too complex? So we then have to have almost like easy mode and hard mode or something like that. So.
I think I don't think people necessarily understand how big of a deal it is that R3 is starting to go down the path of kind of the public network. I mean, it is absolutely massive. I mentioned to you before we started here, I used to look into some of the awesome stuff you guys were doing back in the day, and you support some of the largest, critical infrastructure players that exist out there in the world, tens of billions of dollars in live institutional activity. As those transactions begin, I don't know if bridging is the right word. I would say it almost seems like to me like there's this parallel system, and then as things make sense, they can then kind of come onto the public network. But as those transactions begin operating on, Solana mainnet, what actually changes at a market structure level? Maybe just paint a picture of how big of a deal, this kind of is to you, because you have lived in both worlds.
Yeah. Yeah, it's we look at, so everything we've just talked about is, if you like, the new on-chain yield vaults we're building, and then the picture I have in my head is, once that's up and running, we will be demonstrating to the world, and including the traditional financial world, look at this new source of demand. There is this money, some of it institutional, some of it retail, however you want to describe it. There is this almost like this dry powder powered on chain, and it is demonstrating its willingness and desire to own real world assets. Now, of course, that's because we'll hopefully package them right, so maybe maybe they're pre-looped to get to the right level of yield, whatever it is, but we're showing those demands. And in the first instance, it's quite possible that the tokens that are in our vaults are ones that were tokenized by others, or which we've tokenized directly. But then once that's up and running, we then go to our existing customers and say, guys, you've got your successful networks here. You've got assets issued to them. They're being bought and sold and sort of traded by existing institutions. We can now show, because we can see the demand side. There is now demand for, let's say, maybe for a low risk fund, there's demand for government bonds that look like this, or there's demand for assets that look like this. We know that from what you've told us, because these are private networks, so they have to tell us. We know from what you've told us, you have access to this supply. You've got access to this demand on your networks. All you've got to do is upgrade to this version of the Corda blockchain, 4.14, that ships in Q1 26. It may already be out by the time this goes out. All you need to do is upgrade to that version of Corda. That will then give you the ability to switch to using Solana for your consensus. So rather than having to run your own notary, as it's called, your own private network, you can use Solana for consensus. You still got your private network, but Solana processes your transactions. And that then means, as and when you're ready, you can update your application a small bit. And when we tell you there's demand for this type of government bond, you can just immediately, if you like, auto-tokenize, auto-bridge straight into a yield vault. So we're not forcing customers. We're supporting the Corda blockchain into the future. There's different tools for different jobs, but it's almost like we're giving our customers, almost like giving them a free option. You just by upgrading to that version of the Corda blockchain, they get an option on being able to be the source of assets for these yield vaults. And my hope is once we've demonstrated the demand, they'll want to contribute to the supply.
I think it's huge because I think it's one of the things that is just kind of naturally happening as user experience and as compliance and all the other stuff falls in line. Meeting users where they're at, because I'm assuming every institution that you deal with, every enterprise that you deal with is a little bit different, just like every retail participant is a little bit different. And I mean, I guess the job of the technologist, the technology providers out there is very difficult, which is let's build a user experience that works for everybody. But we are getting better. And I think it makes sense. You guys are keeping the value, the structure that you guys have there kind of fortified, but then you're giving all of the users of what you already have just an option that is, not like future proofing just for a word, but actually enables them to kind of integrate the future as it makes sense to them.
Yeah, without being forced to. Yeah, it's the option. It's an option. It's not an obligation. Yeah.
Sure. So I guess the low-hanging fruit question here is when on-chain or internet scale capital markets are, in your vision, fully operational, what does that actually look like in practice? Not the vision, but real usage at scale.
Well, I guess if I knew that, I hope I know that because that's what we're trying to help contribute to it. I don't know, but I have a guess, which is, and it's one of the reasons, back to the beginning, why we chose Solana, that one of the problems that I guess almost like the world has been battling with ever since we've had computers has been fragmentation of IT systems. So you look at in my early days in IBM, like over 25 years ago now, the first product I worked on, its sole job was to allow two different systems in the same company to talk to each other so they could share data, because the same information should have been in two places and wasn't. And then we moved to the private permission blockchains, and one of the big use cases for our Corda platform in the private permissions realm is simply allowing data to synchronize between different firms. And it's all because rather than having rather than everybody using the same source of truth, everybody has their own copy and it's always out of sync. And the vision that I'm shooting for is you go to any blockchain, whether it's any of them, but just take Solscan, just take Solana for an example, and you go just search for USDC. You go say, I want to see how much USDC has been issued. So you search for that token, bang, you can see 7 billion, whatever it is on Solana. And you can almost say, well, this is the issuer view. This is what Circle could look at. They can see how much has been issued. You click on the holders tab and you can see a ranked list of like who are the whales, who are the largest holders of this. So if you like, that is the issuer view. But you see the list of holders. You click on that, and you get to a holder's wallet, and then because of the way Solana works, you can then see what other tokens they have, and you think, hang on a sec, something changed here. I've switched from the issuer view to the holder view, from if you like, from the liability view to the asset view, and I can now see the entire world from the view of the holder, and that includes not just USDC, it's all the other assets. But I got all of that from a single source of truth. So I saw Circle's view and I saw the holder's view in one place. And you don't get that in the traditional world. And back to the point about Solana is, for as long as possible, this idea of single shared L1 that everything is on, where all the assets, all the trading activity, all the issuances, a single place that supports everything. That's the vision we have to hold on to, because once you move to lots of disparate L2s, lots of separate networks, you get back to the old world, which is everything's in different places and has to be reconciled. So for me, I guess, because I guess fundamentally I'm a technologist, the vision I'm working towards is primary markets, issuance, redemption, and then trading, and then everything downstream of that, the lending and all the stuff we talked about. It's all in one place. There's a single source of truth for all of it. It's phenomenally important, and I think that is the key difference from a technical perspective.
I did an interview. It was like a multi-chain security panel, as far as like safety and security, like a year or two ago. And one of the guys brought up such an interesting example, because you mentioned one of the, the benefits of blockchain and distributed ledger and where these markets are going is you any user will kind of have a full picture comprehensively of what's going on. But the guy was saying, he's like, if there's a security breach right now in the traditional world, there's the individual, inside of an institution, you have the people that know there's a problem, the provider that's going to provide them a solution, and then the ones who have to integrate it within their institution. But at any given time in the world, there's another institution or enterprise that the exact same thing is happening to, but they have no eyes on what happened, how to fix it. So you can imagine downstream effects of how inefficient and fragmented things really are. I think what's going to happen, at least as in my opinion, one of the things that happens with blockchain is kind of the defragmentation of a lot of stuff, hopefully streamlining processes and all sorts of things. From the user experience standpoint, we'll close out here. How does this shift matter for people and institutions who are not already in the crypto space or in blockchain? What changes for how they're going to use capital, how they're going to access, this is kind of the democratization thing again, how they're going to access opportunities or interact with markets and society and all sorts of different things?
Yeah, I mean, actually, just a point just to reflect on what you said on the previous point, about how the one thing I do worry about is by having everything in one place, we lose that fragmentation. But there's also, I guess, a concentration of risk, which is if the underlying network has an issue, then there's that old term, the anti-fragility is potentially less apparent. So we do need to be mindful of the risks. And I don't want to come across as too much of a utopianist, but your point's well made. On what the average person who's not on chain can expect. So I think this is an active debate. So let's imagine our vision is correct and we're massively successful. Then somebody who has stables on chain, the value prop they may face, the benefit to them in a short period of time is they can, maybe some permissioning, I'm not going to put that to one side, but they can access any asset class. So there's a democratization, if you like. They've got access to any asset class in any size with instant liquidity in a way that is fully, can be fully connected to the otherwise professional tools, sort of repo and all that kind of stuff. So that's what we could be beginning to make available. So the question then is the only way to access that by you yourself being on chain? And if so, do we need to make it, is it our job? I suspect not, but whose job is it to help bring those people on chain? And I don't think this is the case, but there is a potential that this is an interim state where we implement all this capability on chain. But the way most people experience it is through, is just through centralized apps, either through their banks or through Coinbase or whatever it is. So how they experience it and how it's implemented may be different. It may be implemented in the way we're doing it, but the experience for most people might be through a, sort of very easy to use app. And then the question, me with my strategy hat on is, okay, well, if that's the case, how do I make sure, that we're working at the right layer of that stack so that we're getting, we or anybody in this industry is getting adequately compensated for the value they add. So it doesn't all just accrue to a layer that you're not working in. But that question about, how will it be consumed, I guess is different from where will it be achieved.
You know, they just started putting commercials on streaming services like Hulu and Netflix. So maybe one day we'll see a commercial for a yield vault, and just you click a button, and there it is. I want to make sure I share for those that watch, that you guys can go and learn more about Corda at corda.xyz, r3.com, at inside_r3. There's tons to deep dive into. You can look into all sorts of toolkits and tooling and all sorts of different information. Please give Richard a follow at Gendal, Gendal. Give Genfinity a follow on X at Genfinity. And you can go and check out all of our articles and all of our podcasts. There's probably about 1,000 of them at this point, but this was one of the better ones for me. I'll tell you, it's been such a pleasure, Richard. This is a bucket list for me. On-chain capital markets, internet markets are coming to Solana. I know you guys are going live in the first half of this year. It's going to be exciting to watch and witness. And don't be a stranger. Come back and maybe we'll do an update space as things start to, as lights start to turn on. So thank you so much, Richard, and hang out with me here for a second.
Thanks so much. That was great.